In no particular order, we have to talk about the markets. Now, specifically the US markets, even more specifically, the Nasdaq 100, the Qs, and the S&P 500, whether that's SPY or IVV or VOO. We have to look at those two and really understand what they're telling us about what's going on right now. And we're going to do it in a very unique way. I'm going to show you this approach in a very unique way, a way that you've probably never seen before. That's number one. Number two, we have to look at real estate. I have two stock charts, price charts I want to show you about real estate. It's going to confuse a lot of people this decade what real estate does. And then lastly, I want to look at volatility. And look, I'm sure I'll throw in a couple other symbols in there, what's going on in the market, some things that are screaming higher, some things that you can probably do a buy and forget about now. Stick around, there's more to come. Okay, everyone, this is RC Peck with Fearless Wealth, and I'm going to talk about three things, as you know. Now, whether you're in the market, you're not in the market, whether you are 70 years old or 47 years old, these things matter because it's going to really teach you how to think like a price chart, which is super important. So we're going to start with the first thing, and I want to look at the S&P 500 compared to, or really looking at the S&P compared to the Nasdaq 100. So the S&P is 500 stocks. The Nasdaq 100 is, wait for it, 100 stocks. So if you look at the screen here, the blue line is the S&P 500. And the red line is the Nasdaq 100. Now, this price chart, just looking at these two lines, this is going from March of 2000 to October of 2000. That's right, we're looking at 2000 here. Same time frame, same interest rate issues, same president, same climate change, whatever stuff was going on at the beginning of 2000. We have two different price charts. We have two different ways of owning the stock market in the United States. And what I want to point out to you is during this period, the Nasdaq is absolutely getting crushed. If you probably can't see, but the Nasdaq, again, the red line on there, and I'm just going to keep saying the Nasdaq, even though it's really the Nasdaq 100, but just know that. So the Nasdaq did a double bottom of down 35%. That's a big number, losing a third. It bounced up, it went up, and then it went back down to that, losing 35% in that time period. Okay. The blue line, which is the S&P, had no idea what was going on with the red line. I mean, during that time period, it was just down maybe 10%, which is almost nothing. And so it was really kind of the tale of two different things going on. Now, that was the beginning of the dot-com crash. What was interesting is I manage people's money, and there's two ways that I have a large portion of their money. I either put them in the blue line or I put them on the red line. And what's interesting is the red line feels more dangerous. And I'm going to do something in a second to show you. It feels more dangerous. But what's interesting about the red line, which is the Nasdaq 100, it often gets to where the market's going before the rest of the market gets there. So this is how the dot-com crash ended, right about there. Now, the Nasdaq 100 eventually fell 83%. But with my approach, you would have gotten out in here. What's interesting about this is you'd have gotten out sooner, and so you'd have been in cash for about 2 years. My point is that at this point, at the beginning of 2000, it looked like the Nasdaq was wrong and the S&P was right. Now, they eventually both fell. One fell 50, one fell 83%. The point being that oftentimes the Nasdaq gets us to a place quicker because it moves much faster. Now, notice I'm staying away from like growth index or, tech. I think the Nasdaq 100 has those companies that have figured out and are running the world. And so they both eventually fell. So I'm going to pose this question. Are we moving into a 2000 where the Nasdaq is saying, yep, things are really, really bad out there. That's why the Nasdaq's fallen down 21% twice this year, and the S&P basically has no idea what the Nasdaq's doing, right? Or do we have another situation where, here's a situation in 2008, okay, where they both fell the same. So the Nasdaq 100 and the S&P 500 fell the same amount in that global financial crisis? Stick with me here. Or do we have a 2015, 2016 where one had more volatility? Now, the red line, which again, if you remember, is the Nasdaq 100, it was way more volatile, but they were both kind of going sideways. Like, so are we in a 2015, 2016? Now, you may not remember, but this period right here saw the beginning of the Fed taking rates from 0% to 2.5%, which is what's going on today. All right, so do we just have the Nasdaq acting more volatile, but there's still volatility with both, but the Nasdaq just has kind of the bigger volatility frame right now. And I'm going to get back to volatility because I said there were three things we were talking about. Okay. Or is it, this case, which this was COVID, where the Nasdaq fell only 28%, the S&P fell 34%. But if you actually look at other parts of the market, and this is really interesting. So let me do this. Let me go back to the COVID crash. There it is right there. And let me show you a part of the market that was supposed to be super duper stable. Now, this is S&P low volatility. I just want you to notice how that low volatility thing was way more volatile than the Nasdaq 100. So the COVID crash was a place where the lowest volatility, the safest parts of the market, were actually the most dangerous parts of the market. Okay, so now I'll go back to sharing the screen, but so let me just go to this. So we have to ask ourselves, what kind of situation is the market in right now? Is the market in where the Nasdaq 100 is just taking on more of the volatility, but we're in that 2015, 2016, but there's just way more volatility, right? And there's a little bit of the 2000 where that volatility is to the downside more, but we take the 2015 where it's like, but we're going to break higher, okay? Or are we in a situation where we're going into a 50, 60, 70% correction, and the Nasdaq 100 is just getting us there quicker? So that's the question. And I think that's the strongest question to be asking yourself. I'm going to come back to this at the end. Okay, so that's what I want you to think about. Which one is it? Or is it a little bit of this? Or is it a little bit of that? I'm going to do real estate last. The one thing I want to show you is volatility. So this is the ProShares Ultra VIX short. Basically, when shit's getting really dangerous in the stock market, this thing spikes higher, right? So this is kind of a way of saying, wow, things are getting very dangerous. And it basically just spikes. It never kind of reverses this downtrend. It just shows spikes. And the spike is really telling us when kind of peak fear has taken over. You can see that with the COVID spike right there. And even if you look to the beginning of that price chart, the end of 2018, the beginning of 2019, you saw that spike there too. That was when Jerome Powell's like, I'm going to raise interest rates a little bit more, even though I already raised them from 0% to 2.5. Now, go look at the most recent part of this price chart, the lower right corner of this price chart. So what I want you to notice is volatility is actually calming down. There's definitely been an uptick in volatility. You see that black line, which is the price. You can actually buy this symbol if you want. It's like a widowmaker. It's a very dangerous symbol to own. I'm just saying it's an ownable symbol. UVXY. What I want you just to notice is the volatility has it peaked? Like there's been a peaking in of volatility, and it's nowhere near what it was in COVID. Even though the Nasdaq 100 via QQQ saw two 21% drops. So in many ways, the Nasdaq really has to hold at that 21% drop. I'll show that in a second. But just notice that this time around when the Nasdaq hit that, and let me just show it down here. I think this will be a nice thing for everyone to see. Let me put down here the Nasdaq 100. Let me show that down here, and let me make the height of this a little bit bigger. So here's this drop where the Nasdaq 100 was down. So the bottom price chart is the Qs. And where I'm showing you right there is where, right there, the Nasdaq was down 21% from basically blue line to blue line. And you can see that spike on the top price chart, right? Can you see that? Let me get rid of these moving averages just so it's cleaner. So the Nasdaq falls 21%, and you can see the top price chart kind of, I don't even want to call that a spike. That's not really a spike. Actually, there's no spiking above that. And then it fell again back down to this 21%. So you could go, this right there, it went back down. But notice how much lower, people are not panicking this time. So that tells me that we are still in kind of this 2015, 2016 moving sideways. People were scared back then. No one remembers that because in between that and this, we had an election in the US that scared a lot of people. And we had, a pandemic that killed, 1 million people in the US, I think, in counting, and greatly accelerated everything in this world, probably a decade or two. And so right now we have the Nasdaq and the S&P still in a sideways trend. And so that's where we are right now. You really want to kind of watch, if you want to watch anything, watch the cues, maybe 320. And let me go back to just, let's go back to just a clean price chart here. And I'll show you what I'm looking at. Then I will move on to real estate. Just quickly showing you the cues here. Just really 320 here. That's really the price to hold. Okay, now let's look at real estate. So I wanted to talk about real estate because it's a harder thing to track. Numbers don't come out every second. They certainly don't come out hourly or daily. But I wanted to show 2 price charts here. So this is median sale prices of homes in the U.S. I think like 2 people in the world knows what median means. So that basically means half the numbers are above and half the numbers are below. So the median sale price in Q1 2022 went up 6%. So real estate went up in Q1 of 2022. The average sale price, which is the average, take all the houses sold in the United States and divide by that number. That's the average. That's an easier number. That number went up 2%. So whether you want to follow the median increase or the average change, they both went up. So real estate went up in Q1, even though, let's get a price chart, even though, let's just pull up the yield on the 10-year, or actually, let's do something better. Let's bring up the 30-year mortgage rate. So the 30-year mortgage rate during a time period where the average price of a house went up 2% and the median price went up 6%, you have mortgages just doing that. That's the average mortgage, 30-year mortgage in the US. Now, here's my point. People are going to get real estate wrong. They think because rates are moving higher that real estate is crushed. I think they're mistaken. Historically, mortgage rates are still very, 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 very low. That's an economic term when you say very 4 times in a row. And so that's where I think people are actually getting real estate wrong, that there's fewer houses on the market. People are living in their houses longer. They're living in their houses on average 10 years and not 7 years. This country's building less than 2 million houses a year. They were building 2 million houses a year in the 1970s when the population in this country was only 210 million. It is now 330 million. What's that, 55% higher? Someone can do the math better than me. Directionally, I'm right. So shouldn't we be building 3 million houses a year? So there's literally not enough houses being built, which I know breaks people's brains. Like, no, they shouldn't be this high. But this is what happens when there's not enough supply. And that's what we're seeing in the 2020s. Okay. So let's do this. Let's wrap up you know what? I wanted to do a little bonus here. So there's some stocks that are getting crushed. Is the crushing done? Is the crushing not done? I'll just bring up one of them, Netflix. Let me just bring up Netflix here for you. So Netflix actually has a history of losing 50 to 80%. Most people don't know that. They've lost 50 to 80% of their price twice. And both times it happened, all the news out was they were going to get crushed. I think the last time they lost 50 to 80%, I think the big thing was that Amazon Prime was adding a streaming service for free. So how the hell can Netflix absolutely compete when you have to pay 5 or 10 or 15 bucks for Netflix when Jeff Bezos Inc. is going to give you all that stuff for free? And so the stock fell 50 to 80%. That's what we're seeing right now. And I believe if there ever was a stock to buy and forget you own it, it is Netflix. You get it, you forget you own it, you put it away, you look at it in 3 or 5 years and you're going to look at it and go, oh, it did about 3 to 5x what the market did. And so there's these periods of time when you have these world-class companies that are literally getting taken out. I think Facebook's another. Now, here's the problem with Facebook. No one likes Mark Zuckerberg. People actually like Reed, the leader of Netflix. They really respect him. Facebook has been taken out. I'm recording this video during market hours on Thursday. It came out with horrible results, but less horrible than people thought they would be. But it's the same idea. All I hear is Facebook's going away. I'm like, probably not. So it's just something to think about. Okay, let's wrap this up, land the plane, but put a bow on this. This is where we are right now. Equities around the world are mostly doing bad, except the ones in the US. And I've talked about this for many months. I've talked about only owning equities in the US for years, actually more than years. There are periods where you do want to own international when they're breaking out. And there have been periods of international breaking out, but they're not breaking out right now. They're actually breaking down. And the strongest stock market in the world is still the US stock market. The Nasdaq 100 is even stronger than the rest of the world markets. So first big kind of takeaway, stock markets are moving sideways in the US. We are, yes, still in a sideways market, and sideways markets are scary. So that's number one. Number two, I think most people are going to be surprised what real estate does over the next decade, but over this decade. We're already a year plus into this decade. And I think people are going to be surprised that when we look back, that real estate's going to be one of those asset classes that does really, really, really well. And part of it is because I also believe we're in this long-term, some people say super cycle, commodity cycle. So physical things and land and property and houses are part of that. And so it's very likely that when we look back at the 2020s, we look back and go, wow, being in physical assets, being in commodities, being in real estate, that was the place. But when I say real estate, I mean actually owning the stuff. So I think that's mostly it. Volatility is not matching, meaning that's called a bullish divergence, what's going on in the market. And that tells us that the market's actually digesting everything that's getting thrown at it. There's a lot of earnings that have come out this week. This earnings quarter is still better than the average. So earnings net of everything are doing well. And yes, some stocks are getting taken out right now, but the overall market is taking it in stride. Thanks everybody for being in my world. I appreciate you. Leave a comment. Let me know where I got it right, where I got it wrong, where you think I was totally wrong, what you think I'm missing. As you know, I read them all, and you often hear me talking about things on these videos because of comments you left. Okay, thanks so much, and I will see you on the next video. All right, bye.